So one of the very first decisions someone makes when they graduate from college or start their first time career is normally they get told about this 401k and they get offered to participate in the plan, and most people don't know anything about what is the 401k, how does it work. And so one of the key things to consider before deciding whether or not to use a 401k as your primary savings vehicle is consider the long-term tax implications that come from it. It's critical to understand if you use a 401k or any type of tax deferred account, when you put the money into that account, you're taking a tax deduction up front. And you're kind of handcuffed with Uncle Sam. You shook his hand and said, I take the tax deduction now and I agree to pay you back later whenever I take the money out. So some of those long-term key tax implications would be remembering, oh yeah, I took a tax deduction way back when I started this, and now that I'm retired and I'm going to take a withdrawal, that's taxable ordinary income, just like I'm being paid that check from a job. And that's going to affect your Social Security tax, whether or not you have additional taxes there. It's also going to affect your Medicare premium every year. It's based on what your earned income is for each year. So that's a key thing to remember. Another thing is there's all kinds of special withdrawal rules that come with 401ks. For instance, unless you take money out as a loan, most people just take it as a distribution. If it's before age 59 and a half, that is not only federally and state taxable, if you have state taxes where you live, there is also a 10% federal penalty imposed on any distribution before age 59 and a half. That can be a big deal. Now, there's a few exceptions: death, disability, first-time home buyer. But outside of that, most of the time that's not the case. We get in a pinch, we need money. If we don't have savings somewhere else, we'll go reach into the 401k and take a distribution. So it's, remember, under age 59 and a half, it's taxable. There's also a 10% penalty. But there's another thing. If you take that distribution directly to yourself, if you say, hey, I need $20,000, it is mandatory from a 401k that 20% immediately goes to the federal government as a mandatory withholding. So if you need 10 grand, you're going to have to take out more than 10 grand because they're going to hold out 20% of that and send off for taxes. So got to keep in mind the tax implications and all those withdrawal rules. Now, there's that younger withdrawal rule, age 59 and a half and younger. There's also an older withdrawal rule we've talked about a lot. That's once you hit age 70 and a half or age 72, if you didn't need the money and you were letting it build up inside your 401k, you have to start taking required minimum distributions. Now, there's a mathematical formula. It's called the lifetime table. They look at that, your balance on December 31st of every year, and say, okay, you've hit the magic number of 70 and a half or 72. You've got to start taking that required minimum distribution, and that is taxable because it comes from a tax-deferred account. If you don't need the income, there's not a way to stop that unless you do some other savvy tax moves, so that's one of the things to keep in mind there. Another thing is, think about your overall option for retirement savings. The 401k is not the only option that's out there. And for a lot of people, they'll sign up for their 401k, and then they'll think, oh, I'm going to buy Google and Amazon and all these stocks and do all these different things, and then they realize, oh, I've only got 5 or 6 options inside this 401k. I can't do all those things. So there are other types of vehicles that you can use to contribute to that can give you more options. So make sure you look at all the options before you get pigeonholed into just one thing. Okay? We would always suggest that if you use the 401k, contribute up to the match that you get from your company. They're only going to match up to a certain point. Don't put in additional contributions above that because you're only going to have limited choices within the 401k. Put in up to the match, get the free money, and then use other vehicles that gives you more freedom regarding withdrawing money and investment options and that sort of thing. Last thing is research the fees that are involved. So currently, 40%, it's estimated that 40% of all Americans have no clue how much they're paying in 401k fees and advisor fees. They just have no idea. They get their statements, they don't understand them. It's really, really important. Think about it. If you're paying a 1% fee versus a 2% fee, it's a big deal. Double the fee for the rest of your life. And a lot of people and a lot of plans and a lot of advisor plans, there can be as much as a 1.5% to 2% annual ongoing fee difference. So make sure you're aware of how much a fee you're paying inside your plan or to your advisor. Control those fees because it will add up and affect your future withdrawals. Here's a couple of other options that are there outside the 401k. The two most common would be a traditional IRA and a Roth IRA. That's known by most people. Well, what's the difference in the two? Well, a traditional IRA is going to work a lot like a 401k in that It's a tax-deferred plan. When you put the money in, it's a tax deduction, but you're going to have to pay tax on the withdrawal on the way out. The Roth is just the opposite. You're using after-tax money going into a Roth, no deduction up front. But the beauty to the Roth is all of the contributions, all of the earnings, interest, when you pull the money back out, it's all tax-free. You never report it, and there is no required minimum distribution on a Roth. So some key things to keep in mind when you think about, well, do I use a 401k, an IRA, or a Roth? Have a handy chart with you, or make sure that you are working with a qualified professional who can say, hey, here's the contribution limit for 2022 for your 401k, for your Roth and your IRA. You might be self-employed and have an SEP IRA, self-employed pension IRA, or a simple IRA. And there are contribution limits on those. And then also things like a Roth, there's actually earning limits. As an individual for a spouse, you can make too much money to contribute to a Roth. So it can get very confusing. That's why you need to make sure that you're working with a qualified financial professional who knows all the ins and outs, all the rules that go with 401ks, IRAs, TSPs, 403bs. And if you need more information regarding something like that, you can always go to our website, www.guaranteedsafemoney.com. We talk about all these things in financial planning on our site.